Will tariff tensions lead to a dramatic drop in interest rates? How much lower could oil prices go? And the appetite for gold continues to climb, and we're seeing evidence of that in the ETF market. Those are this week's market moves. Let's dive in. All right, let's start with the tariff tensions, which are rapidly raising expectations that we're going to see more interest rate cuts in Canada. TD Securities is now forecasting that the country's central bank could cut rates by a quarter point at each of its next 4 policy meetings. That would bring the bank's overnight lending rate to 2%. Remember, when the Bank of Canada first started cutting rates, the overnight lending rate was at 5%. Meanwhile, oil, which has been trading around a 6-month low, could continue to struggle. New research from Bloomberg finds that the price of WTI in New York could reach $60 US in the first half of the year, in part because of weaker demand from all the tariff uncertainty, but in addition, weaker appetite for oil from China is a consideration, and the expectation that more oil supply is going to be coming online from OPEC plus nations. Now, when you take a picture of more supply and weaker demand, hedge funds have been reducing their exposure to oil, according to Bloomberg. Okay, so tariff worries could mean lower interest rates, could mean lower oil prices, but the price of gold? It's been climbing, and ETF demand is on the rise. According to Bloomberg, the ETF fund flows into gold-related exchange-traded funds have surged in the last couple of weeks, and buying begets buying, according to Goldman Sachs, which notes that the combination of ETF interests with central banks, which around the world have been buying more gold, could mean the price of gold reaches $3,100 an ounce US by the end of this year. All right, so a lot of moving parts in these markets. Those are our market moves for this week. Thanks for watching. What market moves are you watching? Let us know in the comments. Don't forget to subscribe. We'll see you next week.